This month's expert is John Finley, Director of Finance at Graystone Tower Bank. John is responsible for the bank's interest rate risk management, investment portfolio, treasury, strategic forecasting, and budgeting operations. John has 30 years of professional experience spanning public finance, executive leadership, teaching, operations, consulting, and public accounting. John is licensed as a certified public accountant and holds the professional designation of Certified Management Accountant. With total assets of approximately $2.7 billion, Graystone Tower Bank's unparalleled competitive advantage is its committed, passionate employees and a strong corporate culture paired with a clear vision that provides customers with uncompromising service and individualized solutions to every financial need. It's a real pleasure to have John as our guest speaker for this month as he explains the impact of the Federal Reserve Bank policy on bank lending strategies.
During the past few years, the Federal Reserve Bank has taken significant actions to manage financial stress in the economy. In doing so, the Fed has sought to fulfill its dual mandate to promote employment and manage inflation. The actions of the Federal Reserve are generally known as monetary policy. The federal government can also influence the economy in other ways, such as through fiscal policy, which is the ability of Congress to authorize spending and levy taxes, regulation, such as health care and financial reform acts, and housing policy, which is largely executed through Fannie Mae and Freddie Mac. In many respects, the financial stress in the economy is a credit quality problem. This is true of defaulting residential mortgages as well as non-performing commercial projects. Losses are borne by market participants, including Fannie Mae, Freddie Mac, commercial banks, and investment portfolios holding defaulted securitized loans. Recent public policy has sought to drive interest rates lower to induce capital spending, stabilize property values, and spur employment. However, when interest rates are very low, further reductions in interest rates rarely change a bad loan into a good loan. This helps explain both the powers and limits of the Federal Reserve. The Federal Reserve has used its three primary tools in significant ways to stabilize the economy. These tools include establishing the federal funds target rate at extraordinarily low levels, promoting access and low-cost funding for its credit facilities, most notably the discount window, and using its ability to buy and sell securities in the open market to influence interest rates. Recently, when the Fed has been purchasing securities, this has been referred to as quantitative easing. Under normal conditions, as the Federal Reserve buys securities, it influences the price paid for the securities and drives interest rates downward. In contrast, when the Fed sells off its portfolio, interest rates are generally expected to rise. Between August of 2007 and December of 2010, the Fed's consolidated assets more than doubled to approximately $2.4 trillion. A large portion of this increase was open market purchases of treasuries and agency mortgage-backed securities in an attempt to drive mortgage rates down. We see how dramatic these changes have been by looking at treasury yields at a few points in time. August 1st, 2007 represents the beginning of the financial stress and is the blue line. November 3rd, 2010 represents the date prior to the Fed announcing quantitative easing 2, which is the red line, and December 15, 2010, the green line, which is a recent point in time. We see the dramatic drop in interest rates between August of 2007 and November 2010. This is most pronounced in short-term rates as well as in the 5 and 10-year maturities. However, if we look at the change in rates between November 3rd and December 15, we see a very different market response to the Fed's formal announcement of quantitative easing 2. Interest rates rose. The current debate about quantitative easing 2 centers on this market response. The question is whether or not the Fed has crossed a line such that the intended impact on interest rates will not occur as expected. For this reason, some argue that the root causes of high unemployment have more to do with high levels of deficit spending, the business risks associated with significant regulation, and the uncertainty regarding federal income tax rates. So what impact does the current Fed actions have on lending strategies of banks? First, it's important to note that the economy is still plagued with credit quality problems. An improved economy fueled by the private sector is more likely to improve credit quality and project performance than lower interest rates. Second, loose lending practices, whether at Fannie Mae, an investment bank securitizing weak loans, or a commercial bank, created the current financial crisis. There is a danger in repeating past mistakes. A public policy that seeks to reinflate the bubble is probably not sound economic policy. Third, extraordinarily low interest rates pose interest rate risks for banks that tend to lend at fixed rates if the funding for those loans comes from deposit products such as money markets and CDs, whose interest rates fluctuate with general market conditions. The Federal Reserve Bank has the same risk by holding long-term fixed-rate bonds funded by short-term deposits. Fourth, bank lending appetite is influenced by potential credit losses, existing capital levels, and the requirements of the Dodd-Frank Financial Reform Act and international Basel III standards. And lastly, I think, healthy banks are eager to lend money for solid projects and credible customers. Banks and customers must manage credit risks. Banks and customers must also manage interest rate risks. And most importantly, these risks can be managed and aligned to the mutual benefit of both banks and their customers. For this reason, there are clearly opportunities to structure win-win deals.
That was John Finley, Director of Finance at Graystone Tower Bank, a full-service community bank operating 49 branch offices in central and southeastern Pennsylvania and Maryland through its divisions Graystone Bank, Tower Bank, and One N Bank. As an expert in this field, John was willing to share with us today some of his insights on the impact of the Federal Reserve Bank policy on bank lending strategies. If you have questions for John, please feel free to contact him directly at the information on the screen. Thank you for watching, and we'll see you next month.